Pratik Agrawal, Chief Investment Officer with ASK Investment Managers. Pratik, since beginning of this year, markets only have been uphill. Do you think now it's time to exercise caution because liquidity is no longer taking this market up? Global slowdown talk has started, and locally all the high-profile events are over.
Okay, I will tend to agree with you. So the part of the market which was looking very cheap at the end of December and valuations had been trashed down really did well over the past 1 or 2 months, January, February in particular, and no longer offers the kind of comfort in valuations it did at that point in time. Second, the big theme for this year had been cuts in interest rates, which would have benefited the levered part of the economy. After the budget, the expectation of the degree of cut, which used to be around 1%, 1.5% before the budget, is now like 0.5%. More importantly, while rate cuts can still be achieved, we believe RBI continues on its hawkish stance, and at this juncture, we don't see any semblance of change in views from the central bank. So, given that they continue to be very, very focused on inflation, and to our mind, being hawkish doesn't control inflation, the components of inflation in the short to medium term at all, because it is supply side, it is because of imported inflation, etc. What may happen is that we give away growth prospects much more than what people are expecting at this point in time. So, to cut the long story short, the idea is to get back to lower beta stocks, which was the story last year, and shun momentum till at least RBI cuts rates more aggressively than what the street expects.
Pratik, how disappointing was the CAG report, and what would it mean for names like a JSPL, Adani, as well as Tata Steel, because the stocks fell pretty hard yesterday?
Well, I mean, too early to comment, but the fact that, even though it was a preliminary report, nobody said that they are not looking in this direction. So if they are, then it definitely means something will come in at some point in time. The working that was presented in the papers yesterday, did not do a NPV valuation. It just totaled the total loss that may have happened, but it could have happened over a period of 30 years. So NPV of that loss would have been significantly lower. But that said, if there is truth in what was reported, there has been a loss. And we are not very sure how transparently the process happened at that point in time. For a lot of companies, if you look at the current policy, it says if you have a captive mine, you should sell power at a cheap price, as is the case with UMPPs, as is what is being proposed for new power plants, where they have to bid on the price of power, and the mine will be given to you free. So the benefit of the mine is coming back to the people of India. This was not the case for some of the mines which got allotted in the first phase of allotment. Now the fact of the story is that at that point in time the scenario was very different. I think most of it happened in 2003-04 kind of a period, if I am not wrong. And those were times when actually Sensex was 3,500 or thereabouts. The growth was not there, and India was not exactly a hot investment destination. So maybe at that point in time, just to kick-start the economy, certain things happened. So one should not forget the context. But yes, whatever was given at that point in time was perpetual. So it wasn't as if you make more money than usual till you recover the cost of the asset, and then you start to share and so on. So yeah, we are concerned.
Are you a buyer in commodity stocks on every decline?
At this juncture, there is a degree of slowdown in last few data points from China, but at the same time, there is an uptick in last few data points coming out of the West. So at this point in time, it's a pretty nicely balanced kind of a scenario. So it's a difficult call. We are seriously underweight commodities. Because of this kind of a dilemma, we don't know as to how demand will shape up. But yes, if there is flow of global liquidity, it helps non-ferrous prices on metal exchanges. Indian stock prices for aluminium, copper, etc. are extremely sensitive to what happens on the LME. So, maybe having a zero exposure there would not be the order of the day. We should have some exposure there.
Pratik, if I look at your December portfolio, you were long HUL, you were long Bajaj Auto, you were long some pharma names. If I look at your latest exposure, HUL is down, Bajaj Auto is static, and BHEL and L&T have made a comeback. So what's next now? What's moving in, what's moving out?
So yes, we did get in some of these higher beta names, and we got out of names like HUL, you are right, which had done very well for us and were looking pricey. But like I said, a lot of the beta that we had introduced over the last 1 or 2 months is being cut, has been cut.
So what are you looking at buying then? Because defensive is a very, very broad term. Defensive includes autos, it includes FMCG, it includes pharma.
No, so we were like 98-99% invested. It would not hurt if we bring up cash levels to like 92-93%.
Pratik, next 10 days the new financial year will start, which is FY13. Have you done any numbers on what are your earning estimates for the Sensex for FY13? And while making those assumptions, are you also factoring in a rate cut?
Well, yes, our numbers for next year would look like 1330 or thereabouts on the index, on the Sensex. Yes, on valuations, markets may seem to be on the cheaper side, but one should remember that the numbers are being achieved by making 2 large changes. One, the recognition of forex losses, at least to the extent of forex loans straight onto the balance sheet. That has helped last quarter numbers. And second, the NPA recognition norms for restructured assets. That will help numbers in the banking space over the next 1 year. The NPA recognition norms for restructured assets the veracity of that is clearly doubtful. And we would expect analysts to make suitable adjustments to say how the profits would have looked if the change had not happened. So with those 2 caveats, this is the kind of number we are looking at, and yes, it does factor in a % kind of a rate cut.
Pratik, I know you own some of these names, gold NBFCs.
Yeah, so there are 2 ways of looking at it. One, all the uncertainty that you may have had is now over, so you know the new set of rules. But the new set of rules has definitely impacted business profitability, at least in the short term, while companies, bring down exposure from somewhere around 68%, 69% as of last quarter end to 60% over the next 1 quarter. So clearly numbers for 1 or 2 quarters may not look good. Secondly, it is pretty clear that RBI is focused on the pace of growth of these companies, and I believe there is a sense of recognition that pace of growth needs to come down from somewhere around 60 to 80% to 30 to 40%. But that again may happen in FY14, FY13 may look like more 15 to 20% kind of growth. But that said, the return ratios for the business may still look pretty good and upwards of 25%. That is our expectation at this point in time. But yes, after the RBI policy, there has been an impairment to business fundamentals very, very clearly.
Pratik, so how much of a catalyst do you think could be this time's credit policy?
So huge. I mean, apart from monetary policy, tell me one other catalyst that you have for the Indian market. Budget really has let a chance go by. It's not addressed growth concerns, it's not addressed fiscal deficit concerns. The numbers are extremely conservative as far as subsidies go. They have just accounted for 3,000 crores for oil subsidies. They are not able to raise passenger fares for railways after 8 years. So where is the hope of raising petrol and diesel prices? So it's not a fiscal game at all. It's now become more of monetary game. So if central bank continues to focus on inflation and decides not to cut rates fast enough, not to inject liquidity fast enough, then while we may continue to have inflation, because a lot of it is supply side, we will not have growth. So it hinges quite a bit on the monetary policy.
Pratik, that's a fair point. But if I make an assumption that Reserve Bank of India will cut rates by 50 pips this year, from an earning perspective, that will not change your overall EPS by more than 2%. So why are markets getting so excited?
No, one is what is the change in EPS in the near term. Second, what is the change in growth outlook over the longer term. It's not only change in interest rates that RBI may do. Frankly, the transmission of interest rates in the banking space happens more if they cut CRR rather than if they cut interest rates, because interest rate cuts only lower the borrowing cost for banks which borrow from RBI. For people which are well run, and most of the PSU banks would have high CASA, some of the large private sector banks have high CASA and don't really borrow too much from RBI window, cut in interest rate, don't really lower down their cost of funds by much. So fact of the matter is liquidity has to be made available, rates have to be cut and sharply to excite people at least from one end. As of now, you just look at new capital commitments, new projects, initiatives and so on, the numbers are falling drastically and tending towards zero. It's like a multi-year low. So from where are we expecting growth to perk up over the next 1 year?
Pratik, local versus global, which are the kind of companies you currently are, are you looking at buying on every decline? Companies which have a large global exposure, IT, Tata Motors, exporters, or companies which have a very strong domestic exposure?
No, so okay, we are looking at not having high beta companies at this point in time. So they may be global or they may be local. Most companies with net cash on the balance sheet with a degree of export orientation and net dollar inflows is the kind of business we like at this point in time.
How are you approaching technology stocks in the current environment, because rupee is now is at a fresh 2-month low?
Yeah, so like I said, technology, pharmaceuticals both offer steady growing income streams and would tend to benefit from rupee depreciation. We believe chances of rupee depreciating are higher than rupee appreciating at this point in time because of high current account deficit. And by the way, somebody drew my attention to this. Current account deficit of India today is probably the second highest in the world. So, as soon as flows stop or reverse, the pressure on the rupee would just be higher. So it makes sense to have exposure to export-oriented businesses, at least as a defensive for this year. And obviously these are businesses which are compounding businesses and will deliver positive returns over a period of a year as well.